Alrighty, welcome to this week's Taxes and Retirement Live. This one is going to be super good. Not that the rest of the weeks aren't good, but this one should hopefully be particularly enlightening. It will be all about annuities discussed and explained in plain English. Let me start with the dad jokes here to give people time to trickle in. A horse walks into a bar. The bartender says, "Hey." The horse replies, "Sure," because horses eat hay. Next, everyone was excited to be at our autopsy club this evening. It was open mic night. Mike, as in, I love these plays on words. I'm a real sucker for a play on words. And finally, 3 of 3, conversation between a genie and a person. Genie says, "I shall grant you 3 wishes. Person says, "I wish for a world without lawyers." Genie says, "Done. You have no more wishes." Person says, "But you said 3. Genie says, "Sue me." Because there's no more lawyers left. Can't sue. Get it? That's the beauty of that joke. All right. Again, so bad they're good. Something else new I'd like to start here is adding a disclaimer. For those of you who see my YouTube videos, I have the standard disclaimer. The Facebook group's really taking off. It's 2,600 people now. I figure I should probably put a disclaimer out in the beginning. Now, there is a disclaimer in the group for everyone who joins that you need to attest that you agree to that. And on the YouTube channel, there's a disclaimer as well, but I figure it can't hurt to actually put one in line in all these videos for all the newcomers and people down the road who watch these things. So give me 20 seconds of your time here and make sure you can see this. This video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see or hear here, first consult with your tax, legal, or investment advisor. Great, that's out of the way. All right, so annuities. Hello, David. Thank you for your comment. Oh, yeah, so comments are working. Feel free to comment and question along the way. I'm expecting there'll probably be a lot of questions that could potentially really sidetrack us from the content here. My goal is to keep this fairly high level. Annuities are wildly complex. No two are alike, as you'll see and get an appreciation for. So I'm expecting there to be a handful of questions that may take us down a rabbit hole. So I'll try to wrangle us in if need be. I have gotten some questions offline from some of you about particulars about annuity contracts you have. And frankly, without looking at the multi-dozen page contract, it's really hard to say what exactly you have, what the feature is, what the annuity does or doesn't do, because that's how complicated annuities are. It's multi-dozen page contracts that govern a lot of these things and have real technical legalese and wild looking math formulas in there that make these things really beast to understand, or some of them at least. Some are incredibly simple, as you'll see from tonight. So anyway, tonight's about annuities. Now, forget what you know or what you think you know about annuities. I'm not trying to convince you they're good or they're not good. I'm just breaking it down as simple and pure as I could to explain what they are, what they do, how they're different, where they're different, and hopefully we get into when certain kinds of annuities could be good in certain circumstances. So stick with me again. Feel free to plop questions or comments in along the way. I will try to keep up with them. If not, I suspect other people may sort of chime in line as you post comments if I don't see them first, because I get caught up talking and distracted. I don't stop and check the comment feed on my screen the whole time. So annuities, my complaint is about most things in life is people who speak at the extremes and assume things are binary. It's this or it's that. It's black or it's white. Lots of things in life, there's a tremendous amount of subjectivity and gray space, gray area in between. Annuities are no different. Many of you probably think or know or assume that a lot of annuities are expensive, complicated, sold only to generate fat commissions for the insurance people who sell them. In some cases, sadly, that is the case. People who sell annuities generally love them for obvious reasons. People who don't sell them, like Ken Fisher at one extreme, you've probably seen his commercials. He's an investment advisor who makes money by charging a percent of assets. His marketing pitch is literally, "I hate annuities and you should too." That's as boneheaded of a view as someone who sells them, who's biased to just pump them out and keep selling them. People who are that shut down to not even considering it, that's as flawed. He's obviously biased because he makes money from managing assets and charging a percent on it, and not from you taking money out to go buy an annuity. That's why Ken Fisher hates annuities, because they hurt his profitability, in my opinion. I mean, that's at least somewhat factual, but some of that's also my opinion. again, just for purposes of tonight at least, try to put aside your preconceived notions or experiences with annuities. Maybe you got sold a bad one. Maybe you have one you absolutely love. I know people who have some of the ones that are historically not liked, but they're working out tremendously well in hindsight for the people who have them. In their risk tolerance, in their situation, it makes sense and they don't have regrets about it. So not all annuities are bad. Annuities, like anything else, are just a tool. They're just a product. They're not inherently good or bad. It's how you use them, if they're used properly or not. That's what determines whether or not it's good or not for you in your circumstance. It's completely unfair to say they're all good or they're all bad because there's so many different kinds that have different forms and functions and may or may not be right for you and depending on what your circumstances are. So that then begs the question, if they're so drastically different, why are they all called annuities? And that's part of the confusing thing. In my view, and I don't think I'm far off with this, there's really two common denominators that all annuities have. Outside of that, it's like, there's not a lot standard about them. The two common things are they are insurance products. They are sold by insurance companies, period. The second thing is that they allow tax deferral, loosely similar to like an IRA or something. When you buy an annuity, it's a contract. It's a contract between you and the insurance company. Money that's in that annuity will, any growth or gains can all sit there untouched until you eventually take it out, and then you'll pay tax. If you have to pay tax, depending on the annuity and whatever, you pay tax when you take money out. So if you buy an annuity that's 10 years, it's not like, it's unlike a CD or a checking account where as you get interest throughout the year, you need to pay tax on it. No, annuities don't do that. Annuities, the tax is all pushed and deferred till whenever you eventually take them out. So those are the two common things, in my opinion, across all annuities. Sold by insurance companies because they're insurance products and offer tax deferral. Outside of that, wildly different. At their core, most annuities, at least historically, before things started to get really complicated, most or all annuities were built on the chassis of a stream of lifetime income. And we'll touch on this, and I'll explain what I mean by that. So at its purest, the most simple annuity is simply you buying yourself a private pension, basically. Like when you work and get a pension, your cost for that pension, what you paid in was your time, your ability to work and produce something, or your mental capital, or whatever it was you did at your job. In return, your company, compensates you, at least partially, by paying you a pension upon retirement. The most basic form of annuity is nothing more than a simple pension. You hand over a lump sum of money to an insurance company. In return, they agree to give you a guaranteed payment, usually monthly, for the rest of your life. It's usually not increased with inflation. You may still be able to buy some inflation increased annuities, but they're like really expensive because it's more risk for the insurance company to make you whole on those inflation increases. But basically, again, its purest form is you give a lump sum of money to an insurance company. In return, they give you a stream of payments for as long as you live, whether it's 20 years or 50 years. And I'll talk more about payment options and what happens if you die early and whatever. So that's the purest form. That's basically you just buying yourself a pension. There's nothing inherently wrong with that. I think most people would agree. It's good to get lifetime stable guaranteed income. And there's only three sources of things that can produce lifetime stable guaranteed fixed income, or maybe fixed with the inflation adjustment. And those three things are Social Security, traditional pensions, annuities. Again, the basic income producing pension-like annuity. Those three things are the only sources of guaranteed fixed income, stable lifetime income that you can possibly get. So to the extent you want or need a certain amount of lifetime guaranteed income during retirement, and your Social Security and or pensions are not enough to cover your income, guaranteed lifetime stable income wants or needs, an annuity is the only thing that can fill that void. There's other things that come close, but it's not the same. Traditional investments, they may produce interest or dividends, but like corporate bonds can go default, or the interest rates can drop and your coupon payments drop. Dividend payments, even for the most secure stable of companies who have consistently and historically paid stable dividends, that's not guaranteed. They can go away tomorrow, they can get reduced tomorrow. Time may say historically they haven't, but that's not to say that dividend won't potentially stop or get put on pause or get reduced. So you can't really put dividends and interest or investment gains in the same bucket as Social Security, pensions, and pension-like annuities. Three things. Um, and the theme I'll sort of keep coming back to. Sorry, just looking at the comments here. Yeah, David Foltz, taking Social Security at 70 is the best annuity in the world. I fully agree. Social Security is the best annuity you can buy. Lasts for life, has survivor benefits, has inflation adjustment. It can also potentially pay benefits to dependent children and other relatives who are dependent on you. And there's other claiming strategies you can do to help maximize it. So yeah, fully agree, David. Social Security, the best annuity you can buy. And by buy, I mean, delay, basically. Instead of taking it at 62, and this isn't right for everyone, not to get off track with Social Security claiming strategies, but the cost of delaying and those foregone payments from 62 to 70 or whenever you start, that's the price, if you will, of buying yourself more Social Security, buying yourself more of what I feel is the world's best annuity. Great comment, David. Thank you. And Wisha says, my 403B is called an annuity. I wonder why. Yeah, right. Great question. So this is where it gets complicated. And this is, some annuities are very much like investments or actually have investment components to them. 403B in the retirement plan sense is that it is an annuity. It's basically a variable annuity. It has an annuity-like bucket where money can sit in there and say tax deferred. You can pick investments inside of it, whatever, and it has annuity characteristics. And oftentimes you are allowed and able to eventually convert your pot of investments into a more traditional annuity, like this guaranteed lifetime pension stream that I was talking about in Wisha. I'll leave it there because that I can get off on a really big rabbit hole with that. But yeah, 403B is technically an annuity. It's called a tax sheltered annuity, or TSA, I guess the acronym would be. So you can't compare, again, traditional annuities, these traditional pension-like payments to investments, because they're not. If you want to do a pure numerical break-even, sure, statistically speaking, traditional investments, plopping your money in some broad-based stock index fund or something, will likely produce more for you than the payments you'll get from an annuity. But it's not an apples-to-apples comparison. An annuity will last until you die, assuming that's the annuity you buy. There's a guarantee. There's zero variability. When you hand that money over to the insurance company, they then take on all the risk of making sure you get your payments. They take your money and invest it, and that's how they generate the income to pay you. But the point is, no matter how bad those investments go or how sour the financial world turns out, they're still paying you. So as far as you're concerned, it's a guaranteed stream that won't stop. It'll last as long as you live. Again, if you live 70 years, you'll continue getting that payment every month. So in that sense, a traditional pension is what's called longevity insurance. Longevity meaning what if you live a long time. A pension, just like Social Security, an annuity, just like Social Security or traditional pensions, is in effect longevity insurance. You're buying yourself insurance against what if I live too long and potentially outlive my investments or savings. Well, this Social Security or pension or traditional annuity will last as long as you do. So it's insurance, and that's why they're sold by insurance companies. Because it's insurance, you can't compare an insurance product to a traditional investment like stock, bond, mutual fund, or ETF. Where it gets real messy is annuities, and we'll walk through this, have become Frankenstein-like products where lots of them do try to look and act like an investment and try to be all things to all people. A lot of it's slick marketing gimmicks. Gimmicks is a bad word, but insurance companies are exceptionally innovative with concocting and cooking up all sorts of bells and whistles and features that they think or know people want. If you have an objection to product A, well, guess what? They'll go cook up product B that has something that you now want so they can then sell it to you. So I genuinely admire insurance companies' ingenuity with how creative they are with coming up with funky and fancy annuities. And for better or worse, I admire their marketing and sales hustle because they're really good at, slick, shiny paper presentations and, marketing pamphlets and selling this stuff and whatever. But anyway, so, okay, a few more comments. Kenan, aren't most annuities today variable annuities? I don't think most. There was a report, there's this company called Wink Intel that's an independent, insurance data, insurance sales sort of gathering consulting group that produces reports and stuff. They just put out their second quarter report. Again, Wink Intel, it's a really good source. Clearly pro insurance because they're paid by the insurance companies and in essence work for insurance companies, even though they're independent. But point is that, they have pretty good data. Variable, I think was, I want to say maybe like a quarter of all annuity sales in the second quarter. Index was one of the big ones. Traditional traditional pension-like annuities were decent size. So I don't think variable were the largest, but they are large, and I'll explain what variable annuities are. Beth asked, what about cash? What about, I guess you mean cash as like a payment as a lifetime stream? Well, you can potentially outlive cash unless you have like, I don't know, 30 million bucks in cash. You're only going to live 10 years. You only need to spend, 100 grand a year. No, you're not going to outlive your cash. Even if there is wild inflation, chances are you're covered. But if you just have a pot of cash, not just, but 200,000 bucks, that probably not going to last you 20, 30, 40, 50 years, depending when you retire and how long you live. Depending how much you spend, plus inflation, whatever. So cash isn't quite the same. Cash can run out. An annuity can't, in theory. Now, annuities are based on the claims paying ability of the insurers. So this is important when you buy an annuity. You want to make sure you buy it from a highly rated insurer, one that has a single A rating, A minus, A plus, A whatever, not the B's, not the C's. Those are the ones that have been around a long time, and chances are will continue to be around for all of our lives. Plus, they have some insurance that if and when they do go insolvent for whatever reason, there's insurance funds that they need to participate in that help step in and make people whole. So Beth, cash, you can't consider cash the same form of guaranteed lifetime income because it can run out, especially if you start spending more or you live a lot longer than anticipated. Josh responding to the variable annuity question. So Jeff pointed out what I just said. Your risk is the insurance company viability then. Yes, 100% correct, Jeff. I would say this. Look for insurers that have been around. I'm not recommending or endorsing any particular ones. I'm just thinking off the top of my head. New York Life, Prudential, Northwestern Mutual, companies that have been around 100 plus years. They've weathered the Great Depression, the financial crisis, the 70s, whatever. And their rating. Look at their rating by agencies like AM Best, is an independent rating company that rates insurers. Stick to the highly rated ones, which are the ones rated in the single A something category. But yes, Jeff, it's ultimately your risk is to the insurance company being able to be there to make you good, make whole on your obligations, their obligations to you. Good point. All right. So again, at its chassis, at its core, think about an annuity as a basic pension. You give money to an insurance company, they in return give you a stream of monthly payments for the rest of your life. That's the simple and pure. But now things start to get complicated. So let's walk through the different types and I'll explain what they are. I got some top-notch presentation equipment for you here. You'll see what this paper is in a second. So there's really three kinds of annuities, 3.5 if you ask me. There's income, there's variable, and there's indexed. And then for each of these three, there's sort of two subcategories. It can be immediate or deferred. And really simple, what immediate or deferred just means when you start receiving your payments. Immediate effectively means you receive it now. Deferred means you start receiving your income payment at some point in the future. I'll leave it at that for now. Now the reason why I say there's sort of 3.5, this is where top-notch presentation materials come into play. There's a relatively new form of annuity called the buffer annuity. It also goes by names of structured variable annuity or variable indexed annuity. And this is why this whole world is so incredibly complicated because there's multiple names for the exact same thing. But I use the term buffer, which is also one of the words used in the industry. A buffer sort of sits between variable and indexed and has features of both. You'll see what I mean as we walk through this. So let's start with the most basic. An income annuity, that's immediate. So income is basically just the traditional pension, if you will. You hand over money to an insurance company, they give you a lifetime stream of income, and if it's immediate, that means those payments effectively start now. Now, technically, it starts like within, I think you have up to 13 months to start it. That's still considered immediate, but to keep it simple, let's just assume you hand over $100,000 today to an insurance company. They turn around tomorrow and start paying you a fixed monthly payment for the rest of your life. That is an immediate income annuity. Simple so far, and I think that's what most people hopefully think of when they think of a pure and simple annuity. Was it? Oh, yeah. It's just quick data point. Again, I'm not endorsing any particular companies, but there's a really good website that you can play around with to get just ideas of how much payment you can buy for a certain amount of money. It's called immediateannuities.com. Now, the guy behind it is an insurance broker. But what's nice about the site is you do not have to put in your name or any contact information. You can simply put in, your age, the purchase amount, whatever, and it'll give you estimates. I don't know how accurate those estimates are. If they're actually actionable, like you can call up and buy an annuity for that amount. But it's a great source to get, a ballpark of what your payment may be. Just as an example, I pulled up a couple before this. If you buy you put $100,000 in, a 60-year-old male can get approximately $420 a month for life. 60-year-old female can only get about $400 a month for life. Difference is, females statistically live longer. So the insurance company knows that, actuarially, they live longer than men. So therefore, they're going to get smaller payments because the insurance company expects they'll be paying you out for a longer period of time if you're a female as opposed to a male. Hence, you get a smaller payment, unfortunately. And then, the older you are when you start, the larger the payment because the less life you're expected to have and therefore less amount of payments. But anyway, so that's a decent tool, immediateannuities.com, to plug in numbers and play around with, get estimates of how much annuity you can possibly buy, income annuity. Again, I'm not endorsing them. I don't know them or the guy behind it, other than from what I'm told, he's an actual insurance broker. So, but the site's slick because you don't have to worry about getting contacted to get sold something. Yeah, so Mark, great point. So what I just mentioned is also called a SPIA, S-P-I-A, single premium immediate annuity. So the premium is the amount of money you buy into the contract, into the annuity. And it's single because it's just one fat lump sum. So single premium, immediate annuity. So immediate because it's starting today, and annuity because it's just a simple, you're buying yourself a lifetime income stream. I want to talk on different payment options. So, what's funny is that a lot of people are concerned about living too long and outliving their money. So then you start talking about annuities, and annuities are, part of the answer, again, because they're longevity insurance, they're part of the answer to help prevent you running out of money. The second people think about buying an annuity where they irrevocably give money over to the insurance company, they went from being convinced they'll live too long to convinced they'll die tomorrow and not get enough of these annuity payments. So they get scared now to buy an annuity. Insurance companies realize that. So, the purest annuity is, in our example, you give over $100,000 irrevocably, give that money up permanently. And the insurance company gives you this IOU that will pay you every month for as long as you live. If you die tomorrow, that payment stops. If you live 50 years, the payment continues every month for 50 years. Well, buyers, clients obviously don't like that risk. If I die tomorrow, I got nothing for it. Now, if you don't have heirs or whatever, maybe you don't care. Maybe it's money that, whatever, if it's gone, it's gone. You're dead, you don't care. But if you do have people you want to leave that money to, then you're not going to like that idea that if I die tomorrow, I basically get nothing for this annuity, and I just spent this $100,000 that, that's gone. So realizing that, insurance companies have different payout structures you can get. The basic one that I just talked about is life. It lasts for your life, regardless how long that is. It stops when you stop living. You can do life with what's called a period certain, meaning it'll last for the longer of your life or some number of years, 5 years, 10 years, 20 years. So if you get like life with a 10-year period certain, your payments will last at least 10 years. If you die in the first year, the next 9 years of payments will continue on to whoever you name as the beneficiary. So that helps, mitigate some of that risk and concern of what if I die tomorrow? Well, your payments won't necessarily stop. They can live on for, up to 10 years potentially. Or if you end up living longer than that, then you'll get them for your whole life. But it's the greater of your life or this period certain. You can also do what's called joint and survivor, and this is most common for spouses. So, spouse A buys this annuity that will last for his or her life. If and when spouse A predeceases spouse B, spouse A's annuity payment will live on for the remainder of spouse B's life. That's a pretty typical payout to get. There's also one with a cash refund, which is, if you die prior to getting enough payments to have recouped your initial purchase, and if you die before then, the difference of what you did not yet get paid can be paid out to your beneficiaries. So if you die tomorrow, all of your premium gets paid back to your beneficiaries. If you die halfway through, basically half your premium gets paid back to your beneficiaries. If you live long enough to get enough payments to more than cover the initial premium you paid, that's it. There's no benefit beyond that. Payments stop when you die. That's about it. There may be some other fine little tweaks and twists, but those are the main types of payment options for these basic vanilla income annuities. Cool so far? All right, so let me take a couple more questions here. A question from Kristen, a story from Kristen. Sorry, just glancing through this quickly. Kristen basically asking about the merits of buying an annuity for her. Can't really get into specific advice for you or anyone, Kristen, about whether or not an annuity is right for you in particular. The gist is, if you want or need additional sources of lifetime income to last as long as you do because you don't have enough assets or you're concerned your assets will outlive you or whatever, then maybe that's the time when considering an annuity can make sense. I will have to leave it at that, unfortunately. David says annuity returns look better because part of the return is getting your money back. Yeah, 100% true, David. So, for example, you can do the math on that $100,000 sample annuity I just went over. You get about $400 a month, which is about round up to $5,000 a year. That's about a 5% return. You may be like, wow, that's good for a guaranteed return. If I go and buy a bond, I'm getting under 1% or something. But the difference is, of those payments, a portion of that payment is a return of your initial premium. The rest of it is, the interest on the premium that the insurance company invested on the money you gave them. So that's why it looks higher, because you're part of it's you paying yourself back. Yeah, I was going to mention there's something else called mortality credits. This gets a little technical, but let me see if I can do this justice neatly and concisely. So the way insurance companies do annuities, it's not just you buying a single annuity. There's you and a bunch of people like you in your same sort of characteristics and risk profile and actuarial summary that all pool up your respective annuities into one big pot. So the law of large numbers and the statistics and the analysis that the insurance company does on the hundreds, if not thousands of people in your pool, they know some people are going to die tomorrow. They know some people are going to live 50, 60, 70 years. But they have really good statistical data saying on average, this pool of people will have an average life of 92 years old, let's say. So that's how they price and value these things accordingly. If you are one of the lucky few who lives longer than the average, you're getting the benefit of getting the money from the people who unfortunately died early and did not get, they paid a lot more premium than they got out in payments. So for people who do live longer, that premium that stayed in the pot and didn't get paid out to the person who died early, that extra premium goes to pay the people who end up living longer. That's called a mortality credit. So if and when you live longer than average, you have the benefit of getting these mortality credits from being in this annuity pool. I'll stop it there. That's kind of more technical than I wanted to get, but that's another reason, in addition to David saying, annuities are partly a return of your principal, these mortality credits are another reason why the payments are relatively higher than what you can get in a traditional investment like a bond or a CD or something like that. And will the amount be adjusted according to inflation? 100K today gets 400 a month today, but what about 20 years from now? No, usually not. And there's usually not inflation adjustment. The quote I gave was no inflation adjustment. I honestly don't know how many insurers even offer inflation. It's called an inflation rider. Rider is just fancy insurance speak for extra option you buy. They call them riders. In theory, yes, you can buy one. I don't know how easy they are to find, or if you can, they're probably going to be expensive because there's a lot of inflation risk, obviously. And so insurance companies are going to price it accordingly. So for example, I'm just making this number up, but instead of $400,000 a month, maybe you only get 300, instead of 400 a month, maybe you only get 300 a month or 250, or I don't know, to reflect for the fact that you'll be getting inflation increases. Yeah, so Dave Myers just mentioned that there are inflation adjustments available. Okay, and Josh replying to Kristen. Good, thank you, Josh. All right, so that was the immediate income annuity. You hand over a lump sum of money, payments start effectively, today or really soon. There's also deferred. Deferred just means you hand over money today. You don't start your payments until some point after a year from now. In the meantime, your money sits with the insurance company. They invest it. It earns some interest so that the $100,000 you deposit with them today grows to, let's just say, I'm making this up, $120,000 of premium in 5 years, 10 years, whatever. So if and when you do start and you turn on your income payments, those income payments are then based on the $120,000 that your initial money grew to over the 5 years or 10 years or whatever the deferral period is. So that's the only difference. So this was the very simple pension that starts today. This is just you give money today, and your pension doesn't start until years down the road. So that would be a deferred income annuity. Good on that. Tommy's asking, are mortality credits a real thing, or are they just a concept used to explain how the actuarial calculations work out? Good question. I mean, functionally, those two are one and the same thing, Tommy. They're real. I mean, whether it's a line item that's actually built into, behind the scenes when insurance companies price this stuff and tell you how much they'll pay you, or if it's just the inherent math behind it, I don't know. But functionally, yes, they're real, in my opinion. David says, I like to say annuities are a return of your investment, not a return on it. You are just getting your money back plus a guarantee that will keep paying you if necessary. Yeah, that's exactly it. I mean, there is a little bit of interest sprinkled in there, Dave, as you know. So Dave's another advisor, super sharp guy. He and I have loosely known each other in the virtual world for a handful of years. We're members of another group and association. Yeah, and he's got a Simpson character as his. I think that's a custom-made Simpson face. That's a picture of Dave Meyer. So yeah, thanks, Dave. Good comment there about annuities. Okay, so Kathy saying, I don't understand the return being my money being returned. I bought a 3-year annuity. The return was better than anything I could get in a CD, bond, etc. I was thinking that percentage was all new income. Right, so that's a different type of annuity. Kathy, I guess I'll mention this now. I'm not sure where this would fit in my structure of 3. So there's something called the MYGA, multi-year guaranteed annuity. It's basically a CD, but a CD you buy from an insurance company. You hand over money, and you can buy one for 3 years, 5 years, 10 years, whatever. The insurance company agrees to a fixed rate they will pay you over that period. And at the end of those 3 years, 5 years, 10 years, they give you back all your money plus interest on it. And because it's an annuity, remember, it's in this tax-sheltered world. So you don't have to pay tax along the way as your MYGA, or multi-year guaranteed annuity, accrues interest. You only pay it when you take it out at the end of 3 years, 5 years, 10 years, what have you. So Kathy, and this is why, again, annuities are confusing. I think we all get at this point an annuity can be this pension-like payment. In your case, Kathy, you basically bought a CD alternative, but it's not a banking product and therefore not guaranteed by the FDIC. You bought an insurance product. It's backed by the claims paying ability of the insurer, but functionally it acts like a CD. You give them money. At the end of the period, they give you back your money plus the interest. The big difference between a MYGA, these short-term CD-like annuities, and a real CD is that MYGAs have stricter withdrawal penalties. If you cancel a CD early, the only real penalty is they take away some or all the interest you accrued. They rarely, if ever, if it's even possible, will take away some of your principal. Insurance companies can do that. If you prematurely terminate a MYGA, they can eat into your principal as a penalty. But that's part of the reason why they're able to give you a higher rate of interest, is because you're committing to lock up your money for longer, so they know they have longer use of it and can do different types of investments with it than if they were limited to only being able to invest it for like 3 months, 9 months, whatever. But yeah, good question, Kathy. So you're referencing a MYGA, multi-year guarantee annuity, which is like a CD-like equivalent issued by an insurance company. And the rates are better than CDs. So a 3 to 5 year MYGA now is 2, maybe 2.5% annual interest. For the higher rated insurers, if you dip down to the lower rated ones, which I wouldn't do, you can maybe eke out a little more interest. Versus a 1 year CD is like under 1% now, I think, depending where you go. Good. Okay, so let me move on here. Let's see, there's other questions. This one's interesting. Let me answer this quick. So Susan asks, is there any way the insurance company can lose on an annuity? Sure. Think about, again, they pool it up, so it's law of large numbers. It's not just like the risk isn't siloed to you and each individual annuity purchaser. So you and however many thousands of other people like you who all buy annuities around the same time and have the same general age and health profile and whatever, some of you are going to die soon, some of you are going to live long. On average, assuming if the average of the pool lives as long as the insurance company expects, the insurance company does well. They break even and make a little bit. But in theory, if every single person in that pool who purchased an annuity lives really long, the insurance company is going to be paying out more than they anticipated, and that's where they lose money. Susan, hopefully that answers your question. But again, it's law of large numbers. A lot of people, there needs to be a really big demographic shift, unexpected demographic shift in life expectancies for the insurance company to lose noticeable amounts of money on annuities. Terrence, at what age should someone look at longevity insurance? Sounds like a deferred income annuity, correct? I'll take that offline, Terrence. I mean, it all depends. Generally, I would say consider it the older you are because you get more bang for your buck. Because if you buy an annuity at 40, it's not going to pay you a lot because the assumption is you're going to live 50-ish years. If you wait until you're 70, 80, start getting up there in age and be like, oh man, I'm still healthy. I may have another 20 years in me. Then maybe you consider buying a longevity insurance. If you are, your savings and assets are dwindling and there's risk that you may potentially run out of money, then you may consider it. Because at that later stage in life, when you're 70 and 80, your payment's going to be pretty high. Because statistically, the insurance company assumes you're not going to live much longer than 15-ish years or so. All right, let's move on. So we went through income annuities. Variable. Do we have 2 days to discuss this? So variable is, this is where things get complicated. It is partly an investment. It's still sold by insurance companies, but there is an actual investment component to it. And the important thing to know is there's two stages or phases in a variable annuity. One is what's called the accumulation phase. That's where you deposit your money, your premium, your initial purchase, whatever. It gets invested in whatever you choose to invest within the confines of what the insurance company allows you to invest in. So it accumulates during that time. You're not taking money out or anything yet. You're just building up your pot of money as an investment. And then when the accumulation stage or phase is over, then you decide how and when you want to pull money out of it, or that's the payout phase, if you will. And during the payout phase, there's kind of two main options. One is you can annuitize it, and annuitizing it is like at that point buying yourself a vanilla plain income annuity. You hand the money over to the insurance company, they in return give you a lifetime of payments. That's annuitization. Or there's lots of bells and whistles called income riders or income options. You can buy these extra features that aren't annuitizing it. It's not this irrevocable handing over of money to the insurance company. It's instead a guarantee that they will let you basically withdraw certain amounts of money every year from your contract without handing it over, but still have the benefit of being able to withdraw from it. You can buy those riders, income or withdrawal riders. This is really get confusing because functionally, these things all sort of act the same, these different income or withdrawal riders, but the marketing wizards at the insurance companies are free to call them whatever they want. So they're all going to have their own slick branding to them, their own names, their own labels, which makes it really hard to compare and contrast. So you can't get hung up on what it's called because, again, it's probably going to be some funky, cool sounding, pleasing word that whatever that their marketing people came up with. You have to dig into the contract and see how it actually functions, and what it's doing is what matters. Don't worry about what it's called, worry about what it does, which is what makes analyzing annuities really complicated. But anyway, so in variable, there's these two phases. There's accumulation and there's payout. The accumulation phase, things sort of look and act like traditional mutual fund-like investments. The insurance company will give you a roster of a few dozen different investment options you can invest in. There will be some bond funds, some equity funds, some cash or money market-like funds. And then whatever happens with those investments over the course of, let's assume it's a 10-year accumulation period, it can go down, it can go up, it's gonna do whatever your investments do. At the end of that accumulation period, then you have the option, okay, what do I do with this payout? You can take all your money and leave. You can annuitize it, irrevocably turn it into a stream of income. You can just take dribs and drabs out here and there and leave the rest invested and let it do what it's gonna do. You can roll it over to some other annuity or whatever. So there's lots of options in the payout phase. It's called variable because your return, your initial contract, and whether it goes up or goes down, is variable based on whatever the underlying investments do. You can definitely lose money, you can lose value in your contract if your investments go down, or it can go up if your investments go up. Now, what's tricky about it is it's not a pure investment because it's an insurance company and they like to make things really slick and have all these bells and whistles and reasons to overcome objections for why you may otherwise not want to buy something. There's these features and floors and backstops. So, for example, you can buy a rider that says, whatever the actual value happens, I want to buy something that guarantees it won't go lower than X. Well, that's going to cost you money. There's also life insurance components to this typically. If you die, before you start the income phase, before you start the payout phase, they will often guarantee you that whatever amount of initial money you put in, we guarantee your heirs will receive at least that much, even if your contract drops in value because your investments dropped in value. So that's a slick sounding feature, but that costs you money as well. There's fees built into the annuity for all that. So if you're looking at a variable annuity as a pure investment, it's going to lose almost every single time because there's all these other insurance components and features and bells and whistles tacked on that all come at a cost. Typically, and this ranges, but it's not uncommon to have like a 1 to 1.5% what's called mortality and expense charge baked into it. That's sort of the cost for all these insurance aspects of it. There's also usually like a 0.25% administration fee that the insurance company charges for the record keeping and producing statements and doing regulatory reporting, whatever. And then there's the underlying fee of the funds or accounts in which you invest. Just like mutual funds have their built-in expense ratio, so do these accounts, these mutual fund-like accounts you invest in your variable annuity. Now the problem is, most annuities, some do, but a lot don't use the cheap, good, diversified Vanguard-like funds. They'll stuff these things with the higher expense, actively managed funds that are. It's not uncommon for your fund options to have like a 1% average expense ratio to all your options. So that eats into your return as well, because you're investing in a fund where you're losing 1% every year right off the bat in fees, versus if you're in a comparable low cost like index tracking fund or something, its expense is only 0.05% or something like that. So, all in, you're looking at 2 to 2.5% in fees in this variable annuity. That's going to be a drag on your returns. So you can never compare a variable annuity's investment performance to traditional investments because it's going to lose almost every time. But that's not why you buy a variable annuity. Or if you do, you bought it for the wrong reason. You're buying it for the other features because hopefully they're important to you, not just because someone sold them to you. You're buying it for the insurance components if you want or need that. You're buying it for the eventual ability to convert it into this lifetime stream of income, whether it's this income rider or you're just going to choose to flat out annuitize it and convert it into a pension. You're buying it for those optionalities and features. For those optionality and features, you pay a fee. So that's why investment people hate variable annuities, because yes, in variable annuities, from a pure investment growth perspective, will lose virtually every time. But it's not apples to apples. There's all these other guarantees and insurance and bells and whistles that make it more expensive and not a fair comparison. So that's my skinny on that. I don't want to get too much into riders. They get really complicated. I do have, on my YouTube channel, I did really thorough videos. It's like 20 plus minutes each. One for income annuities, one for variable, and one for index, which we'll talk about next. And I go through charts and graphs, and you can see all this stuff play out with real numbers and figures and stuff like that. So definitely check those out. This live now is just, I'm trying to keep it as high level as possible, but if you want the nitty gritty details, definitely check out the YouTube channel. So variable annuities, what I just discussed is inherently a deferred variable annuity. Again, immediate versus deferred just means when you start your income. The fact that there's this, let's assume 10-year accumulation period, that means you're deferring it. You pay your premium today, you're not turning on income till, let's say, 10 years down the road, so it's deferred. I think there are immediate variable annuities. If there are, they're not common. So that would basically be you hand over $100,000 to an insurance company today. They in turn agree to give you a certain amount of payments, but those payments will be based on the value of your account and how its investments go up or go down. So that would be an immediate variable annuity. Payments start today, but payments are based on your investment performance of your account. Again, they're not very common. I assume you can buy one if you really wanted to, but most of these variable annuities are going to be deferred, where you're allowed to invest and hopefully build up contract value before you eventually annuitize it or turn on some other form of income option. Okay, so that's variable. Oh, and one other thing, I sort of touched on this with the MIGA, the multi-year guaranteed annuity, is surrender periods. And this is another reason why people who don't like annuities often don't like them, is you're locking up your money for a long time. Or if you take it out early, there's steep what's called surrender charges or early withdrawal charges. So going back to the example of a 10-year deferred variable annuity, there's almost always going to be this decreasing scale of annual withdrawal charges. So in the first 10 years, and most annuities allow you to take out 10% of your value without penalty for free. Whatever, no special penalty. If you take out more than that, then the surrender charges come into play. In the first year, it's not uncommon for it to be like 10%. So whatever you take out above your free allotment, you'll have to pay a 10% penalty on. The second year, the withdrawal penalty will be maybe 9%, then 8, 7, 6, 5, whatever. They'll eventually tail off, whether it's 5 years, 10 years. I've seen some that are well beyond 10 years. I saw one that was like 20 years the other day, which blew my mind, but they exist. That's also part of the price you pay for getting all these guarantees. That's the inherent nature of insurance. It's not diabolical. It's not, consumers don't like it, but it is what it is. Insurance companies need the sort of known commitment and guarantee that they know how long they're working with your money. That allows them to go do other types of investments that can lead them, let them keep that money locked up for longer. So if and when you take it out early, they kind of slap you on the wrist for it. The other big reason for these surrender charges, and this is what's kind of dirty about insurance in my opinion, is to basically pay back the commission that the person who sold it got. And let me tell you what I mean by that. So if you buy a variable annuity all loaded with the bells and whistles, it's not uncommon that the person who sold it gets like a 10% commission on the value of what you bought. So if you put $100,000 into this variable annuity loaded up with all the features, assume the person who sold it gets a commission of $10,000, up front. Now sometimes they can choose to stretch it out, but it's also possible they can take that in one big fat lump sum check of $10,000. And you don't pay that directly, and this is why I don't like insurance. They say, nope, there's no cost to you. You don't pay my commission. It's paid by the company whose product it is. Well, you're paying for it indirectly, and here's why. The insurance company needs you to stay in that contract long enough so they can make enough money off of you being in that contract, so they can recoup that $10,000 they had to pay to the salesperson who sold it to you, because that was their commission. So if you pull the ripcord and jump out of this annuity in the first year, guess what? That's why the surrender charge is 10%, because you're basically now paying back, by them taking out some of your money, you're paying back the $10,000 commission that they just paid a handful of months ago to the salesperson who sold it to you. So the longer you're in the contract, the less and less steep that surrender penalty is, because the more money the insurance company will have made off you in the interim to help recoup the cost of the commission they paid to the salesperson. Make sense? So that's part of the reason why these surrender charges are there. Again, is it dirty? I don't like it. Not to get too off track here, but when I was in college, I wanted to be an advisor. I interviewed at a lot of the large household name banking and insurance companies were on campus interviewing for roles they called financial advisor. I interviewed a few of them. Quickly realized they were all just product sales, insurance sales, mutual fund sales, and it was all commissioned. And I heard all the lines of things like, yeah, you tell clients they don't pay you, we pay you the commission, right? Things like that. And it was, give me a list of 100 of your friends and family so we can go, market and sell to them. And very just typical sales culture, all about production and numbers and, winning free vacations and trips and incentives. So I got turned off by that and gave up on it. And, this was 20 years ago. And I stumbled into an actuarial role at a large insurer, not doing any sort of sales or whatever. But so I've worked, in the industry, seeing the inner workings of it ever since. But that was my introduction to the industry and rubbed me the wrong way. It was very much a sales culture. So admittedly, I'm a little biased against, the strong sales culture of a lot of insurance places. So forgive me if it comes out that way. But, I don't think I'm far off in saying that's why these surrender charges exist. It's partly to recoup the large commissions paid to the people who sold you the annuity if you leave the annuity early. All right, that's variable annuities. Any other questions here? Cannon asks, don't annuities provide a better return when interest rates are higher rather than in the current environment? Yes, they definitely do. So now, isn't the ideal time to buy an annuity when interest rates are rock bottom, especially the basic immediate income annuity, because interest rates are a large determinant of the rate that you get. But you can't really try to time the market. Like if your situation is such that you want or need to buy some income right now, you're kind of at the mercy of interest rates. But yes, if interest rates, if and when they go higher, payment amounts on annuities will go up, Cannon. And then we just comment, this was to someone else. But you could also potentially get higher payments and rates from lower rated annuities, but that's a slippery slope. To incentive the lower rated, weaker insurers to incentivize you to buy their product as opposed to buying a product from the top rated, household name companies that have been around 100 years. They have to sort of dangle a carrot in front of you and pay you a little higher, pay you a little more than the higher rated insurers would. But you're taking on more risk that insurer who's weaker rated, has a higher chance of going bust and not being there to pay you out potentially. So that's sort of the downside with shopping just for the highest payment as opposed to looking at the quality of the insurer as well. Carol asks, what are your thoughts on laddering annuities? In what sense, Carol? Do you mean laddering like MYGAs? Like the CD-like annuities where you're buying some now that mature in 5 years and then buying some more? If that's what you're talking about, yes, that could make sense depending on your circumstances. So that gets into what's called sort of like a bucket approach almost, where if your income needs over the next 5 years are A, B, C, D, and E, and you want zero variability about where that income is going to come from, yes, you can invest in a series of staggered maturity CDs or MYGAs, these CD-like annuities, where you invest enough that in year one you're going to get whatever $50,000 returned to you. In year two, it'll be $50,200. In year three, it'll be $50,000. Stuff like that. So yeah, it works. It's no different than laddering CDs or laddering bonds. It's I'd say a very conservative way to go about it, depending on the rest of your income sources, pensions, Social Securities. If those cover most, if not all, of your required mandatory expenses in retirement, not your fund spending necessarily, but your required stuff. If Social Security and pension covers it, I'm of the opinion that most people don't need to pay for the additional guarantee of other lifetime income, such as from annuities. Not to say you can't, but depending on your risk profile and your views towards maybe you want 100% of your income guaranteed, then sure, it's a consideration. But I don't necessarily think it's a necessity, Carol. Josh is laughing. Josh Bloom, ha ha ha. I'm not sure at what, but hopefully it's a good laugh. Jay, what time we got? All right, let me take this last question. So Jay asks, what about an annuity that adds $6,000 per year regardless of what the stock market does? Not entirely sure what you're talking about, Jay. It's probably you're referring to some sort of income rider where regardless what the stock, the stuff you're invested in does, your annuity is guaranteed to go up a certain amount of dollars every year. With income riders, though, this is going to get confusing, and definitely check out the video on variable annuities to see more about this. That's not a real $6,000, assuming this is what you're talking about. That's not a real $6,000 in your pocket, in your contract. It's just added to this hypothetical phantom base of money, and that phantom base of money is the amount upon which your income rider payment will be determined. So like if you were to liquidate your contract today, chances are, if I'm thinking about what you're thinking about, it's not going to actually be $6,000 higher every year. That's not cash in hand you can take out. That's just this phantom base of money used solely for purposes of determining this income payment down the road if you purchased an income rider. But check out the variable annuity video on the YouTube channel, Jay. I think that may be what you're talking about. Okay, all right. Indexed annuity. I'll talk about an indexed deferred annuity. So again, deferred meaning you put the money in today, you don't take any income out for 5 years, 10 years, 7 years, whatever. Index is weird. It's not actually an investment, but the return or the growth of your contract is linked to a traditional investment index or financial market index. Most commonly, it's the S&P 500, which, as you all presumably know, it's the 500 largest companies whose shares trade on United States stock exchanges. So the way an index annuity works, and there's lots of names and labels for this stuff, which is why it makes it confusing, but and I have a video on this that walks through it all. It'll help a lot. You get what's usually called a participation rate. So like if the S&P goes up 10% and you have, let's say, a 60% participation rate, your contract will only go up 6% or 60% of whatever the S&P went up. So you're limiting and restricting your upside gain. The benefit, though, is in most index annuities, they guarantee your contract can't lose value in a given year. So if the S&P has a down year, your contract doesn't go down, it's zero growth for that year. So you get to participate in some of the index upside, but none of the index downside. That's an indexed annuity, in the most straightforward sense. There's other sort of ways they can do it. So they can also put a cap. Instead of like a participation rate of less than 100%, they can simply cap it. They can say, you'll get 100% of the S&P return up to only 4% per year. So if the S&P goes up 3%, yours goes up 3%. If the S&P goes up 8%, yours only goes up by the cap of 4% or whatever percent I said. So that's another way. They can also skim some money off the top. Well, it sounds dirty like that, but there's something called the spread, where whatever your gain is for the year, they'll take a flat 2% off the top. So whether your contract gets 8, they'll take 2 off, so you get 6. Your contract gets 4, they'll take 2 off, so you get 2. That's a spread. So there's lots of ways insurance companies, they're still making money on this, is my point, which they should. I mean, they need to be in business to make a profit, obviously. But they're confusing because people say, oh, it's linked to the S&P, so I'm going to think about it like it's a stock-like return. Far from it. Definitely don't ever consider or try to compare an index annuity's potential returns to the potential returns of its underlying index. You'll never get there because it's capped or participated rated, or spreaded. You're always going to get less than what the index gets. But historically, these index annuities have churned out 3 to 6% per year with no risk of going below zero. So in that sense, they're more like a bond investment. The returns are relatively stable, chance for a bit of upside, but capped downside. So it's more like a stable sort of bond-like investment. That's the right way to view an indexed annuity. Even if it's linked to a stock market return, it's still ultimately going to act more like a bond. With that in mind, it's not necessarily a bad product if a bond-like return is what you want or need. The big selling point of index annuities is that they're no fee, they're no fee, they're no fee. Technically true on the surface. It's no fee like a bank account is no fee. It doesn't mean the insurance company's not making money. It's just that they're not explicitly charging you 1% per year or whatever. They're just simply by paying you less than what they make on it behind the scenes, that's how they make money. So yes, it's true that there's no fee with most index annuities. Where there is a real fee is the surrender charge. Again, they'll typically have a 5 to 10 year surrender charge, where if you take your money out of your index annuity in that period, that's a real fee. They'll deduct you, 10% or 5% or 4% or whatever your surrender charge is. That'll come out. That's a real fee. But assuming you stay in the contract for its full length of life, it's true that there is no explicit outright fee. There is a commission paid to the person who sold it, but you don't pay that directly. It comes from the insurance company. Again, if you leave the contract early, you are now starting to basically pay back that commission by way of having to pay the surrender fee. Cody, I often see that the participation is often in an S&P 500 low volatility index, not actually the S&P 500, and the index is often determined by the annuity company, further reducing upside. Yeah, right. Annuity companies are incredibly innovative and creative with how they structure and market stuff. A lot of them do flat out use, the S&P. Most use it without the dividends return. It's just the price change of the S&P, which is lower than if you include the dividends. But some do come up with these custom concocted indices, which they're allowed to do, but it makes you wonder. what the motivation is behind it, but not necessarily good or bad, but there's a reason why they're doing it clearly with these custom indices. But generally, it's going to be a major index like the S&P 500. So that's a deferred index annuity. So again, deferred because you put the money in today, it's going to do what it's going to do. It'll grow 3 to 5, maybe 6% per year in index annuity. And then at the end of its accumulation period, let's assume that's 10 years, then you can choose what you want to do with it. Take it all out, take your ball and go home. You can annuitize it, which is irrevocably convert it to a lifetime stream of payments. Or maybe you bought one of these income riders that you tacked onto it that will let you take systematic withdrawals out of it without actually irrevocably annuitizing it. Those are all possibilities for how you get your money out. So that's an index annuity, a deferred index annuity. And finally, the third and a half type is the buffer annuity, which is relatively new. Again, also called a structured variable annuity or a variable index annuity. It has features like both. The best way to think about it is the variable annuity can very much go down in value because you're invested in actual investments that can go up, can go down. So there is very much risk of loss. Index annuity, there's typically not a risk of loss. Your loss is capped at 0, but your upside is significantly reduced as well. Or your loss is floored at 0, not capped, but your upside is significantly trimmed down. A buffer is in between. A buffer, you will share in some of the downside, but it'll be floored. Maybe you're only allowed to lose up to 2% per year, or only a half of what the index is, or whatever. You're not going to have dollar for dollar loss along with your investments. Your loss will be floored at something less than 0, but not unlimited. And your upside, therefore, for you taking on some of that risk of loss, your upside now will be a little higher than what it will be in an index annuity. They'll give you more participation in the upside. It's not going to be unlimited upside like it would be in a variable annuity, but it'll be something more than indexed. So buffer sits in between. You can lose more than indexed, but not as much as variable. You can make more than indexed, but not as much as variable. That's a buffer. I'll leave it there. I think that sums it up fairly well. Again, there's multiple names for that. What else? I think that's it. Simple, right? So that's as plain English as I can make it. It's hard to do without diagrams and graphs, so definitely check out my videos on YouTube. Again, there's 4 of them: income annuity, variable, indexed, and QLAC, which is qualified longevity annuity contract. That's a special kind of deferred income annuity that you buy inside a tax deferred account. There's a few rules and restrictions about what qualifies, but basically it's like an RMD friendly deferred annuity that lets you defer beyond 72 RMD age. So that's a deferred income annuity, a QLAC. So check out those videos. There's lots of graphs and step through this thing in good, vivid detail to explain these riders and the fees and whatnot. Anything else here? No, so that's it. Looks like comments and questions are done, which I thought there'd be more. I don't know if that's good or bad, but either this explanation was so thorough and great, no one has questions, or it's still people are amazingly confused by all this, which I completely understand. I wouldn't be surprised if that's the case. All right, that's that. Thank you all. Thanks for showing up. Hope you enjoyed this. Next week will be estate planning basics. Again, high level. I'm not an attorney, and I try not to play one on Facebook Live, but I will be talking about the high level things to consider when putting together an estate plan. Hold on, one more question here, just I'll pop in. Maureen, does it ever make sense to do a SPIA or MYGA within a traditional or Roth IRA just to get off the market risk roller coaster? It can. It all comes down to your risk, your willingness and ability to take risk. It's not the end of the world to do that. I'm just trying to think. I mean, generally you want like your higher growth stuff to be in a Roth, so all that growth will eventually be tax-free. A SPIA or MYGA isn't producing much growth. I mean, it's by definition, it's producing flat and stable, minimal growth. So not ideal. I mean, if you could do it inside a tax-deferred account like an IRA or something, that would make more sense generally. But if the only money you have is in a Roth, which is a good problem to have, and you want or need the stability or longevity insurance of an income annuity or MYGA, do what you got to do. Don't let anyone tell you you can't or shouldn't if that's what's best for you and your circumstances. Okay, just looking at the other. Liliana, when do annuities make sense in general? It depends on the type of annuity. If it's an annuity that's producing income, it's if and when you need additional lifetime stable guaranteed income above and beyond Social Security or pensions. If you're buying one of the MYGAs, the multi-year guarantee annuity, that's a kind of like a CD equivalent. So if you just want or need to invest some money for a few years and you want to squeak out a little more interest than what you get in a CD, then maybe consider a MYGA. That's an annuity, but it's very far from the traditional income stream annuity that most annuities are built around. A MYGA is just kind of like a CD. So it could make sense then if you want to invest some money for short term that you could not touch for a few years. You want guaranteed interest and you want a little higher interest than what you can get in a CD. Liliana, good question. All right, looks like that's it. So thank you all. I will see you next week for estate planning. Have a good week.